the next article, which is getting into the market. Follow these tips to improve your credit score. Another one was written by Kevin Pangle, one of our supporters here at the station for Evergreen Mortgage. And, there's just a sort of a list of items that can help you. And I'm just going to read the headlines on this. And of course you can deal with this, but, to work with your credit score, one, obviously it helps to get your credit score so that you can identify, and in many cases, there's an item that was satisfied actually some time ago, and it still appears. And just that process alone, getting that off of your credit score so that you can move forward, may take a little bit of time. So if someone has told you that it's going to be 3 years before you can qualify for something and you're at year 2.5, this is still not a bad time to get out and see that mortgage broker and talk to him a little bit. Go, how am I doing? How's my credit looking? Is there something I can do to build it up? Are there any blemishes I need to remove, so that it gives you enough time and you're ready to go? So, the things to kind of keep an eye on is, your payment history. Are you making your bills on time? Are you doing that? Are you, the next item is sort of keeping your debt to a minimum. There's a lot of assumptions and a lot of things that are told to us and sold to us like it's really to our advantage, when in fact what they're trying to do is extend credit and get us to borrow money so that we can pay interest on whatever we borrow. And credit and having lots of credit cards with low balances and all that sort of thing is really not necessarily to your advantage. And so to keep your credit scores and to keep things in line, to have a couple of open accounts, what you would like to see is maybe a little bit of a spread. Certainly you'd like to see a spread between the available amount of credit, or the credit that is available to you, and the existing balance. So in other words, if you have a $5,000 credit card and you've got a $4,500 balance on it, that's not really a good thing. If you have a $5,000 credit card and you've got a $100 balance on it, that's a much better thing. And one of the things that they look at on those credit is just sort of a figure to take away. And I know that these people that would help you build your credit would be more than glad to help you talk with that at a greater deal. But the rule of thumb is, at your current rate of pay, would it take you longer than 6 months to pay off the balance? So let's just go back to the same one that I just gave you. You got a $4,500 balance and you're making $100 a month payments. Well, obviously it's going to take you longer than 6 months to pay that off. But if you had the $100 balance, you'd pay it off within a month. So that's considered short-term debt, and that doesn't go against your income to debt ratios. That doesn't count as something you carry. The other one would then reduce your monthly income by that $100 a month payment minimum, and then adjust your number down. So, and then be wise on your, not only on your credit history, but on managing your credit. Every time somebody wants to run a credit card, or they say that, you go to the Macy's store and we'll give you, 10% off your pair of $20 shoes, which is only $2, and then they're going to ding your credit by doing a credit check. Just be mindful of that. Kind of watch how many times credit reports are being printed for people. And sometimes when you're going out, like if you're going out to shop lenders, let's say, to go ahead and get a copy of your credit report, or the first one that runs a copy, ask for a copy of it, so that when you go and talk to a couple of different parties, you can take your credit report with you, so that each party isn't running a credit report against you. And lenders will be more than glad to put that together, but realize that whenever you get a loan, that there's actually 2 times that they're going to run your credit. They're going to run your credit at the beginning to see if you qualify for it. And then right before close of escrow, they're going to run your credit report again. So one of the mistakes that actually has happened a couple of times in my practice in the years is they went out and bought a motorhome. They went out and incurred a bunch of debt, buying a bunch of new furniture and a bunch of new things that they're going to use in the new house, or bought a car, not being mindful of the fact that it was going to change their income to debt ratios, and thereby it was going to be harder for the loan. And then what happens is either A, they may not get the loan, or B, they could get the loan, but the interest rate's going to change, and it's generally not going to change in a favorable direction if you've incurred more debt. So anyway, that's a good one to be mindful of.